Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Since our last quarterly equity update at the end of March, the S&P 500 has declined by 17%. We want to walk through the three variables that stick out the most to us heading into the second half of this year. First is the Federal Reserve's current policy or continuation of their tightening that we're seeing in relation to the high inflation rates that we're all experiencing. As you can see from this chart, the Fed still remains way behind the curve. We have inflation rates of nearly 9% compared to the same time last year, and the Fed funds rate is still below 2%. They're planning to get up to maybe about 3.25% is their guidance for the end of this year. We'll see if they can actually get there without breaking something in the economy or the financial markets. But the key to us is this is very different from previous tightening cycles where they were trying to slow down inflation. If you look at this chart, in the 1980s as well as the late 1990s, the Fed funds rate was above the inflation rate. So the navy blue line above the light blue line, and that was what helped bring down inflation. This time around, they're not going to get the Fed funds rate up to 10% to try and do the same thing. They would cripple the economy. So without them saying it, they're trying to tighten enough that they create a, in their minds, manageable recession, because consistently it's been recessions that have the best track record of slowing down inflation. That makes this current bear market, with stocks having declined by more than 20% from their high at the beginning of the year, different from every previous bear market going back to the great crash in 1987. Because this time, the Federal Reserve is still tightening. They're still increasing interest rates despite the fact that the market's gone down more than 20%. In every previous case, going back the last 40 years, the Fed usually would have pivoted and started to be more accommodative to the financial markets and try to stimulate things. But because they have to continue to tighten, to continue to try and fight inflation as their number one priority, we think that increases the risk that this bear market and decline in financial asset prices could continue for the foreseeable future. We're already seeing this impact with consumer sentiment. The University of Michigan has been doing these consumer surveys going back to 1952. And we included two of the charts here to show that they're seeing some of the lowest readings they've ever recorded in terms of consumer interest in buying a vehicle or a household appliance. I didn't include the chart here about the current environment for buying a home, but it's a similarly extremely low level. And we're seeing that start to filter through in consumer spending activity in the last couple of months. Where this is relevant for investors is that the earnings growth expectations for companies in the market are still too high. If we look back to 2007, over the last 15 years, the earnings per share growth for the S&P 500 has been about 7% a year. But for this year and next year, analysts are expecting 10% annual growth in each of the 2 years, which doesn't make sense to us when we already just had flat real growth in the U.S. economy in the first half of this year, and we're still tightening and trying to slow this economy down more. So we would expect that these earnings growth estimates have to be revised down. For context, in past recessions, on average, the earnings revisions have to come down by about 20%. So for instance, the 2023 number, where they're anticipating 10% growth, might have to be pushed down to a 10% expected decline in earnings for next year. But that's not in the numbers right now. And we think that may start to filter through with companies reporting earnings in July and August and possibly having to revise down expectations for investors and analysts about what profits to expect for this year and next year. The negative earnings revisions are going to primarily be due to falling profit margins. Now, the chart on the right here looks at operating profit margins for the S&P 500. They peaked in the middle of last year. And that's relevant for us because on average, profit margins peak about a year before profit growth would turn negative in this sort of recessionary scenario. So the fact that we're a year later from that peak in profit margins, this may be about the time that you start to see earnings growth really start to slow down and potentially even turn negative. The chart on the left is one we included because this market has been trading on free cash flow and free cash flow yields for the last 6 to 9 months. It's the companies that have zero free cash flow right now that have incurred the largest share price declines of 70 to 90%. So it's noteworthy to us that for the overall market, free cash flow margins fell by 1/3 in a single quarter, when numbers were reported in the first quarter this year. And it's something we're going to continue to monitor closely for the rest of 2022. As an example of what can happen when you see profit margins all of a sudden decline very quickly, Target had this happen to them in May when they reported their most recent earnings report. They announced that their profit margins for this year were going to be cut by 1/4, and the stock also came down by 25% that day. We saw a similar earnings report from Walmart, which revised down its margin guidance and went down by 20% in a day. If we look around other sectors, very recently we're starting to see weakness in the cyclical sectors that would start to do worse in a recessionary scenario. So there's been a bit of a sell-off in energy positions. Material stocks have been underperforming. Industrials have been down. Financials, mainly banks, have been underperforming. And some consumer discretionary names that had been holding up because of this thought of the economic reopening after COVID of the last couple of years, such as travel stocks, those have been coming down. So these are all signs to us that a recessionary scenario is starting to be more factored into the marketplace, but we still need those earnings revisions to come down, and we still are watching valuations to see if those come down more as well. On that front, at the start of the year, valuations for the market were far too high, and that was our main case for why we expected a pullback in the market. Now we're back to about average for the S&P 500, which is about 16 times is its long-term average price-to-earnings ratio. But in a typical low after a bear market, we could see this fall down to as low as 14 times, possibly even lower, but 14 times would be our number where we'd start to get more interested. The key, though, is the earnings number in this ratio, in our mind, is inflated. They're using an earnings number for this price-to-earnings ratio that has not been revised down like we think it will. So even though we think valuation could come down even further, we could also see the earnings generate additional 10 to 15% fall off in the share prices. So that could actually end up being as much as another 25% down in the market in a more worst case scenario. So all of that being said, we're trying to treat this pretty cautiously, knowing that this could be one of those drawn out bear markets, similar to what we saw from 2000 to 2002 or 2007 to 2009. For our long-term growth strategy, at the end of the first quarter, we were down to about 60% net invested in the market. And when the market rallied up to some new short-term highs in the middle of the second quarter, we pulled that back even further to about 40% invested, because we do think there are still some issues with earnings revisions needing to be brought down. Maybe valuation needs to come down even a bit further. So we're going to continue to remain cautious. We have our list. We know what type of companies we want to buy. We're seeing some that are starting to show some good valuations, but in a drawn out bear market like this, especially when the Federal Reserve is still tightening and raising interest rates, it pays to continue to stay very patient and disciplined and waiting this all out until we really think that we've got a phenomenal opportunity, which could very well develop sometime in the next 18 months, but it just pays to keep cool and watch this all unfold. We hope that gives you an idea of how we're seeing the markets heading into the second half of the year. If you have any questions, please contact us.